Is your dream Texas home about to become a financial nightmare? With mortgage rates soaring, overbuilding exploding, and investor panic looming, some cities in the Lone Star State are heading straight for a housing correction in 2025. Which booming suburb might be the next bubble to burst? Could your neighborhood be on the brink of a major price drop? From tech-driven cities to fast-growing college towns, we're counting down 10 Texas cities where home prices could crash hard. Number 10. Frisco. Frisco, one of Texas's flashiest boomtowns, where high-end homes, luxury amenities, and shiny new developments have transformed this Dallas suburb into a real estate magnet. But in 2025, Frisco might just be heading toward a serious market correction. And here's why. The warning signs aren't just blinking, they're screaming. The median home price in Frisco has hit a jaw-dropping $675,000, nearly double the national average. But price appreciation has hit a wall. While home values surged 24% year-over-year in 2021, that growth plummeted to just 3.8% in 2023. That's not just a slowdown, that's a screeching halt. Meanwhile, the construction boom hasn't slowed down at all. Since 2021, new building permits have exploded by 156%, with 12,300 new units flooding the pipeline. That's a recipe for oversupply, especially when buyer demand is cooling fast. Here's the kicker. 42% of mortgages issued in 2022 and 2023 are adjustable rate. With current interest rates floating above 7%, those homeowners could soon face monthly payment hikes of $800 to $1,200 once those teaser rates expire. Imagine opening your mortgage bill and seeing it jump by $1,000. That's enough to trigger panic selling, and fast. And let's not forget taxes. Property tax assessments in Frisco have jumped 28% in just 2 years, hitting homeowners with bigger bills at the worst possible time. Add in rising insurance costs, up more than 34% statewide since 2022, and it's clear the financial pressure is mounting. Frisco might still look like a luxury paradise on the outside, but the numbers under the hood are cracking. If enough adjustable-rate mortgages reset and investor-owned homes hit the market at once, prices could slide hard. In short, 2025 might be the year Frisco's real estate fairy tale hits a plot twist. Number 9. New Braunfels. New Braunfels, a charming German-rooted city nestled between San Antonio and Austin. At first glance, this place seems like a dream. The population has skyrocketed by 56.5% since 2010, and the vibe is a mix of old-world charm and modern boomtown. But here's the issue. The housing market is overheating, and 2025 could be the year this bubbly market pops. Home prices now average $380,000, a hefty jump for a city that once flew under the radar. Yet, the cracks are forming. Housing inventory has surged 62% since 2022, and many of those homes are sitting longer on the market. Overbuilding is catching up fast, with supply starting to outpace demand. Infrastructure isn't keeping up either. The city's water and sewage systems are operating at 92% capacity, and upgrades are lagging by nearly 40% behind population growth. Schools are stretched thin, with student-to-teacher ratios exceeding state guidelines by 23%, a sign the city's support systems are under strain. Investor activity is also raising eyebrows. 41% of properties are investor-owned, and if these owners start pulling out during a downturn, it could trigger a wave of listings that flood the market. That's dangerous, especially with vacancy rates rising from 4.8% to 7.2% in just 18 months. That's a red flag for rental market saturation. And let's not forget affordability. Rising property taxes, mounting insurance premiums, and increasing living costs are squeezing locals who are already stretched thin. When the basic systems can't handle the people and prices are peaking, something's gotta give. New Braunfels is a great example of how booming too fast can backfire. Unless infrastructure, jobs, and affordability catch up with the rapid growth, the housing market may very well correct hard. For 2025, keep your eyes on this one. It's a beautiful city, but the housing stress signals are flashing bright red. Number 8. McKinney. McKinney has long been one of North Texas's darlings. Historic downtown charm, family-friendly neighborhoods, and a booming real estate scene. But the numbers behind the growth are turning from impressive to alarming, and 2025 might be a wake-up call for this upscale suburb. Right now, the median home price in McKinney is $500,000, nearly 2 times higher than the national average. But here's the issue. Local incomes haven't kept up, pushing the price-to-income ratio to 5.8, well above the healthy benchmark of 3.5. That gap is making homes unaffordable fast, especially as mortgage rates flirt with 7%. Adjustable-rate mortgages are another big concern. A whopping 34% of recent originations fall into this category, and as these loans reset in the current high-rate environment, monthly payments could jump by $800 to $1,000. Homeowners on tight budgets might be forced to sell, leading to a flood of listings and price declines. Meanwhile, the construction train hasn't stopped. With 4,600 new homes already in the works and another 3,000 in the approval pipeline, McKinney could face a serious oversupply problem, especially when buyer demand is softening. Schools are bursting at the seams, operating at 112% capacity, and traffic congestion has soared 47% since 2020. On top of that, commercial real estate vacancies have increased from 8% to 14%, hinting at a softening job market. That combo of high housing costs, slower employment growth, and overbuilding is the perfect storm. To make things worse, insurance premiums are up 42% due to more frequent severe weather events. Add that to rising property taxes, and the cost of homeownership here is spiraling. McKinney might still look like a safe bet on the surface, but underneath the pressure is building. If the economy stumbles or mortgage resets begin en masse, McKinney's real estate bubble could start to deflate quickly in 2025. Number 7. San Antonio. San Antonio, the Alamo City, is one of the most culturally rich and fastest-growing cities in Texas. With its historic charm, thriving tourism, and strong military presence, it might not scream housing crash. But quietly, the signs are creeping in. And 2025 might bring a reality check. First, the median home price in San Antonio has risen to around $317,000, up significantly from pre-pandemic levels. While that may still seem affordable compared to Austin or Dallas, it's now outpacing wage growth. The Housing Affordability Index has dropped sharply, signaling that more locals are priced out of buying. Home builders have been busy here, really busy. Permits for new construction surged during the 2021 to 2023 boom, and now inventory levels are rising, just as demand starts cooling. Builders are beginning to offer incentives and discounts, a classic sign of oversupply. Local employment is another concern. Outside the military and healthcare sectors, job growth has been tepid, with sectors like retail and service lagging. That's a problem when most home buyers depend on steady paychecks, not just hope. San Antonio also faces mounting financial pressure from rising property taxes and insurance premiums, especially as weather-related claims have gone up across Texas. These added costs are eating into budgets and pushing many homeowners to the edge. And let's talk about investors. During the 2020 to 2022 boom, investor activity surged here, especially in rental homes. But now, as rents plateau and vacancy rates rise, many are trying to exit. When too many homes hit the market at once, prices don't just soften, they slide. The city's urban sprawl adds another twist. Long commute times, rising gas prices, and limited transit options are making far-flung neighborhoods less attractive, reducing demand in outer ring suburbs. San Antonio might not be collapsing just yet, but the ground beneath is shifting. If mortgage rates stay high and buyer demand stays cool, this big city could see a price correction sharper than anyone expected. Number 6. Denton. Denton, a buzzing college town that feels alive with music, creativity, and student energy. But don't let the fun vibe fool you. Beneath the surface, Denton's housing market is starting to wobble. And if trends continue, 2025 could be a shaky ride for homeowners and investors alike. The median home price in Denton has climbed to $385,000, which might seem reasonable, until you realize that nearly half the city's population is made up of students from the University of North Texas and Texas Woman's University. This makes Denton highly dependent on student housing demand, which has started to decline. Occupancy rates in student housing have dropped from 96% to 88% in just 2 years. That's a huge swing in a town where 48% of the total housing stock is rental-based. And with 9,000 new housing units added since 2021, in a market that usually only absorbs around 3,500 units annually, there's a growing surplus of housing. The city's job market outside of education isn't doing any favors either. Non-education employment has only grown 1.2% annually since 2022, while the housing stock has grown 4.8%. That's a mismatch that could trigger falling prices and higher vacancies. Worse yet, property tax delinquencies have risen from 1.8% to 2.9%, a subtle but serious sign of financial stress among homeowners. And when you add in rising insurance costs and inflation, the pressure just keeps stacking up. Denton's identity as a vibrant, youthful city is great, until that youth stops showing up in the same numbers. If university enrollments continue to dip and overbuilding keeps flooding the market, 2025 could bring a tough lesson in market correction. For landlords, buyers, and investors, it might be time to rethink the syllabus. Number 5. Bowmont. Bowmont, a city that's weathered more than its fair share of storms. Literally. With its roots deep in oil refining and shipping, Bowmont's economy can be hit or miss. And when it comes to housing, 2025 could be a big miss if conditions don't stabilize. Bowmont's home prices are relatively modest, hovering around $207,000. But that doesn't mean it's immune to a crash. In fact, its economy is highly dependent on a few volatile sectors like oil and petrochemical refining. When oil prices tank or plants scale back, the ripple effect can hit the housing market fast and hard. Another major concern is risk exposure. A significant portion of Bowmont lies in flood-prone zones, and FEMA's revised maps will place even more properties in high-risk categories by 2026. That's not just bad for safety, it's expensive. Flood insurance premiums could rise 45% to 180%, making homes even less affordable. The job market has also been stagnant. Employment growth in the region lags behind the state average, and there's a shortage of high-paying jobs to support rising living costs. Meanwhile, home ownership rates are slipping, with many younger residents unable or unwilling to buy due to uncertainty and cost. Public infrastructure hasn't seen major upgrades in years. Roads, schools, and drainage systems are aging, and they're not keeping up with even modest population growth. This underinvestment has started to reflect in property values, and don't overlook climate risk. Hurricanes, rising sea levels, and extreme weather events have made insurance companies raise rates across the board. In Bowmont, insurance premiums have soared more than 38% since 2022, adding another burden for homeowners. So while Bowmont might not have skyrocketing home prices, it's at major risk from the other side: declining demand, storm vulnerability, and shaky economics. In 2025, don't be surprised if this Gulf Coast city faces a quiet but painful housing shakeout. Number 4. Plano. Plano has long been the polished jewel of North Texas. Think corporate campuses, upscale neighborhoods, and sleek suburban living. It's the kind of city that looks recession-proof from a distance. But under the glossy surface, Plano's housing market is flashing red lights that smart investors shouldn't ignore. Home prices here are anything but cheap. The median home price is hovering around $510,000, and many neighborhoods have climbed far beyond that. This pricing surge was fueled by years of high-end development, major company relocations, and investor speculation. But now, the momentum is stalling. One big issue: luxury overbuild. Between 2020 and 2023, construction permits in Plano spiked to historic levels, and much of it was in the luxury tier. Today, builders are quietly offering incentives and slashing prices to move inventory. That's not a great sign in a supposedly hot market. Even worse, a surprising 40% of recent home sales in Plano involved investors, not residents. That's a big number. And it means if the market softens, these investors could start dumping properties quickly to avoid losses. When that happens, home values drop. Fast. affordability is slipping away. Many locals have been priced out, and new buyers are stretching their budgets dangerously thin. Combine that with rising mortgage rates and property taxes that have gone up 25% in the last 2 years, and you've got a lot of financial pressure brewing. Let's not forget that corporate relocations to Plano have slowed, and several employers are falling short of projected job creation targets. That softens the demand that once fueled the housing frenzy. Plano still looks shiny, but the foundation underneath is wobbling. If investor confidence cracks or interest rates climb higher, 2025 could see Plano's high-priced housing market fall harder than anyone expected. Number 3. San Marcos. San Marcos has always been a lively, student-filled city with a laid-back rivertown charm. It's the kind of place where young energy meets small-town vibes, and it's also been one of Texas's fastest-growing markets. But now, it looks like San Marcos is heading toward a housing hangover, and 2025 could be the breaking point. The median home price here is around $340,000, which might seem modest compared to Austin or Dallas, but it's a massive leap from just 5 years ago. And for a town where 61% of the housing stock is rental property, that price surge isn't sustainable, especially when student demand softens. That's the kicker. Texas State University's enrollment has dropped 3.2% in recent years. This might sound small, but when your entire rental economy relies on students, every percentage point hurts. Rental vacancies have surged from 5% to 8.5%, and landlords are starting to feel the squeeze. Despite these red flags, new construction hasn't stopped. The city has 2,500 new units in the pipeline, threatening to oversaturate an already softening market. And with job growth barely ticking at 0.9% annually, there's not enough economic activity to absorb that extra supply. Flood risk is also rising, literally. FEMA's updated maps have placed 18% more properties in high-risk zones, making flood insurance not only mandatory, but also expensive. That adds hundreds, sometimes thousands, to annual housing costs, especially painful for younger buyers. It's a perfect storm. Fewer students, too many rentals, rising insurance, stagnant jobs, and still more housing coming. San Marcos may still feel like a college town party, but financially, the music is slowing down. 2025 could mark a tough lesson for homeowners and investors banking on eternal growth. Number 2. Dallas. Dallas is a titan of Texas, a city with towering skylines, major business hubs, and a booming reputation. But even big players aren't immune to market corrections. In fact, Dallas might be headed for one of the sharpest housing price drops in Texas. And the reasons are piling up fast. The median home price in Dallas is about $410,000, which is a significant rise from just a few years ago. But that surge in pricing hasn't been matched by wage growth. The price-to-income ratio has climbed above 5, and affordability is tanking. The Housing Affordability Index for Dallas dropped from 82 to just 63, meaning fewer middle-class families can afford homes. Dallas is also heavily investor-influenced. Over 36% of home sales in recent years have been investor-owned properties, including entire subdivisions of rental homes. This investor saturation creates volatility. When home prices wobble, investors are the first to bail. That could flood the market with inventory and trigger sharp price declines. The job market is still strong, but it's cooling. Many corporate relocations announced in the last few years have underdelivered on employment promises by nearly 34%. Meanwhile, downtown office vacancies are rising, and the tech sector is quietly cutting back. Commutes are another hidden problem. Dallas's suburban sprawl has worsened, and average commute times now exceed 35 minutes, pushing homebuyers to reconsider the value of outlying neighborhoods. With remote work growing, proximity to city centers isn't as vital, reducing demand for urban homes. Rising property taxes and insurance premiums, especially with Texas's increasing severe weather events, are squeezing homeowner budgets. And with mortgage rates still hovering around 7%, demand is taking a serious hit. Dallas is still flashy on the surface, but look closer and you'll see the pressure points. If investors start unloading properties and buyer demand continues to weaken, Dallas could face a price correction of 15 to 20% in certain submarkets by mid-2025. Big city, big warning signs. Number 1. Austin. Austin, Texas's tech crown jewel, music mecca, and the ultimate magnet for millennials and money. But after years of explosive growth, sky-high prices, and non-stop building, Austin's housing market looks dangerously overcooked. If there's any city primed to lead Texas into a real estate downturn, it's this one. Austin's median home price is $567,000, one of the highest in Texas. That's after rising over 70% between 2017 and 2023. But now, the cracks are clear. Prices have already dropped 5.2% in the past year, and days on market are climbing. Buyers are backing off, and sellers are starting to sweat. The tech layoffs haven't helped. Over 23,000 tech workers in the Austin area lost jobs since 2023, thanks to major cuts at companies like Oracle, Meta, and even Tesla. That's a huge blow to the high-income buyer base that helped fuel the boom. And now, 47% of recent homeowners are considered house poor, spending more than 33% of their income on housing. Oversupply is another ticking time bomb. New housing inventory is up 89% from 2022, with 18,500 units under construction. That's a tidal wave of homes hitting the market at a time when demand is already softening. It gets worse. 36% of recent sales were investor-owned properties, and if these investors panic sell during a downturn, prices could spiral quickly. Meanwhile, property taxes and insurance premiums continue to climb. Texas already ranks 7th nationally in property tax rates, and Austin's are higher than average. Remote work has changed things too. Buyers no longer need to live in Austin to work in tech, and many are choosing cheaper suburbs or even out-of-state alternatives. So yes, Austin had its golden moment. But 2025 could be the wake-up call. With layoffs, high prices, oversupply, and investor risk all converging, Austin might not just lead the Texas correction, it could define it.